All right, welcome back to Two Stupid Guys Trade Stocks. I'm Vinny,
I'm Dylan.
and today's video is kind of in response to a critique or comment we got on a video talking about how Dylan and I have kind of a negative feeling towards like meme stocks and cryptocurrency and things like that, and that they thought it'd be useful for us to talk a little bit more about position sizing and like how you can still allocate part of your portfolio towards these kind of high risk investments while still not blowing up your account.
Yes, because once you blow up your account, you lose.
Yeah, exactly. Dylan and I both definitely believe in like you can take flyers of things. You just have to do them in a reasonable, like careful manner.
Yeah.
So a little bit about position sizing here. This all comes down to the golden rule of investment here. Is Warren Buffett. I'm sure that many other people have had a paraphrased version of this. He may have even paraphrased this from someone else. But rule number one: never lose money. And rule number two, don't forget rule number one. It's a little bit like Fight Club.
Yeah, I was gonna say it's Fight Club. Okay.
Yeah, basically. Yeah, exactly. But that really is like the whole point of this, man. If you lose all your money, you don't have anything to continue investing with, and then you're like out of the game. You can't win the game if you're not in the game.
Yeah, I think one of the issues with the meme stocks is people are almost playing it like it is a video game, except in a video game you can just press restart. Whereas you can restart in this too. It just takes 10 years or whatever you risk to get your money back. And it's just not a great idea.
Yeah, exactly. I mean, you can go back to your day job and just keep earning money there, but it'd be much better off to not blow up your account in the first place. So this little kind of graph here is about like diversification and risk. And basically it says as you approach 20 stocks in your portfolio, that you if they are carefully chosen, you can basically diversify away all individual, as they call it, unsystematic risk, which means that risk associated with a specific stock or industry. Now, that doesn't prevent you from being exposed to the system-wide risk, which is the whole market in general can tank. As Dylan will tell you from swing trading, sometimes it doesn't matter. If it's a red day, everything can get taken down with it, whether or not that stock deserved it.
Yep. Rule number one: don't swing on a down day.
Yeah, exactly. But that's the basic premise there. So you can start to diversify it away. So me, as more of like a value investor oriented guy, every position I open, I spend, I would say, usually 8 hours of research prior to opening the position, looking at the company financials, looking at analyst reports, looking at competitors in the industry, reading through like their annual report, reading through like the latest quarterly filings. So when I go into a trade, I feel I typically have a higher conviction in that trade. Therefore, I'm more comfortable with putting a larger portion of my portfolio into that investment. So for my very high conviction investments, it's usually 20 to 25% of my portfolio is what I'll target for something like that, which is in line with like the classic Buffett partnership. I don't know if you ever heard this story back in the day, but when Buffett ran his investment partnership, that used to be his rule. 25% was like the maximum for an individual position.
I'm actually surprised it's that high with him.
Well, yeah, I mean, if you when you're doing it from that perspective of you really understand the business, you're less afraid of like concentration in terms of your portfolio. When you really truly believe in the company and it's at a great price, like it's kind of hard to not buy as much as you can afford.
Right.
So there's this great story about Buffett when he actually violated that rule. He went all the way up to 40% in one individual investment. It was actually American Express. American Express had insured a shipment of it. I want to say salad oil or some sort of oil. And there was some fraud involved where basically someone had filled the tanks with water and insured it as if it were like this, oil product. So American Express was on the hook for, I think it was in the order of tens of millions of dollars in losses. Granted, this is quite a long time ago. So that was significantly more money at that time.
Right.
Yeah. But so American Express was on the hook for that. And as a result, they kind of got really beaten up in the market. So that's when Buffett went basically all in, putting 40% of his partnership and assets into American Express at that time.
Oh, is that one of those things where there's a negative catalyst and it caused American Express to probably lose like $3 billion in
Yes.
market value when they were fined 40 million, because that happens sometimes. Those are usually like golden opportunities.
Yep. That was what he did. He saw that golden opportunity and he loaded up the truck, Um, so the other kind of position sizing I use here is, 10% or so for, investments I feel pretty good in right now. This is like Bank of America. I have about 10% of my portfolio in Bank of America. Um, then high risk, high reward plays. This is where I think your meme stocks, like cryptocurrency kind of can belong, is in this 1 to 2% category. Like, truly, if these things are gonna, 10x or more over the next decade, then what's the big deal of putting 1 to 2% of your portfolio in it? You're still gonna end up with 10 to 20% of the money you have now. If it were to 10x, that's still a great return.
So the answer that people are going to say is, well, if it's going to 10x, why wouldn't you just put 100%?
Yeah, because it could also 0x.
There you go.
Yeah, that's the real answer, So like for me, this recently, I just closed my Virgin Galactic position on Friday. That was about 1% of my portfolio. Yeah, I was up 80%. I was like, all right, I love it. I'm taking this win and I'm going to walk home with it. All they can do is go downhill from here. It's one of those buy the rumor, sell the news. Once they actually finally put Richard Branson in space, and right, yeah,
Once they actually put Richard Branson in space.
Hopefully he comes back, or maybe not. Did you see the petition on Jeff Bezos
to move it up?
No, there's like over 100,000 signatures saying don't let Jeff Bezos back in.
Oh my gosh.
I love it. But in value investing, I don't use stop losses either. If the investment tanks 30 to 40%, sometimes I'll consider about buying more, because if I really feel that solid about my underlying investment thesis, there's no reason for me to doubt that at that point.
I got a question for you. If you don't lose stop losses, how much do you hold a certain percentage of cash?
No, I don't necessarily hold a certain percentage of cash. I will keep cash in the account when I close out a position, and then as I'm waiting for something else that feels like it's investment worthy to me.
Okay.
Yeah.
So this is a good example on. So my biggest weakness is position sizing, because I see an opportunity. I'm just like, I'm just going to go all in. So the top graph is my swing graph. It's not really the same timeline, but it's close enough. The green arrow, the white arrows on the top, that's where I added money. So the percentage isn't really accurate. I think it's actually around 180. But when you add money, it acts as if you always had that money in the account. So it kind of messes everything up. But as you can see, there are like a couple steep incline and declines.
Yeah.
That is not good investing. That is pure luck. That's when I first started. So I had like $2,000 at that point in. I was like, man, this is easy. Why doesn't everyone just do this? It's called Movie Pass.
Movie Pass right here.
Yeah. And then, the down ones, I'm really glad it happened, because it helps me learn, and it helped me. That was when I learned a little bit, take fundamentals into account. And then that other big drop is COVID, and that's called being margin called. So position is something I'm still working on. I'm still not great at it, but it's very important. Like, it's super. I'm really good at it in swing trading. My long trading is terrible.
Yeah. Yeah, it depends on what sort of stuff you're doing. I mean, I wanted to put together this quick example on like position sizing and swing trading, basically. So you determine what's your R value. R value, when you see Dylan's weekly swing trade videos, he's talking about R value, risk to reward ratio of 5 to 1, basically, or something like that. So the R value is typically a percentage of your portfolio that you risk for each trade. An example would be if you had about a $50,000 portfolio and you were looking for 1% R value, which is pretty much in line with what swing traders kind of recommend. Is that what you're saying, Dylan?
1%, yeah. And just to be clear, it would be risking 1%, not the total capital involved to buy the whatever your stock you're buying. Exactly. So it might cost like $4,000 to get the shares, but the max you would lose is $500.
Exactly. So a 1% R value for a $50,000 portfolio would be about $500, and you should always use a stop loss when you swing trade. Always, never delete it. Don't delete it.
The 2 times I've done that this year, it cost me $7,000.
Yeah. It's tough. You got to be disciplined. If you're trading a certain system, you got to kind of follow that certain system. So here's an example of how you would figure out how many shares you would buy if you're using an R value of $500 right there on a $50,000 portfolio of 1%. So what you have to do then is calculate the per share max negative like delta or difference. So you're looking at your entry price minus what your stop loss price would be, and that's based on what you're looking at in terms of the graph, right? Yeah. So you're looking at this $500 max. So you divide that by the number of that per share loss that you would have, and that will tell you the number of shares that your position size should be to have the correct R value. So, you get into like a little bit of, you can get really fancy when you start talking about, portfolio management in terms of risk, reward ratios. The hedge funds like ETFs will use things like modern portfolio theory, which basically asks you to use a model which uses correlation and variance. So you're trying to see how volatile that each asset is, and that's where you get the variance from. And then you're also using correlation in terms of how related they are, which is kind of funny because like Dylan was talking about this with gold and like how it used to be thought it would be negative correlation, mean an opposite kind of movement with stock market, but in reality, they're actually much more aligned.
Yeah. It does not. I lost money figuring that out like 2 years ago.
Exactly. So you have to actually look at the true correlational values and not just perceived correlation of asset classes. But there was
a solid 6-month period where Vinny was getting texts of the gold price and the stock market price for the day of me just being angry saying everyone has been wrong for 50 years.
Yeah. Gold is not a great hedge against the stock market declines. But so this right here is looking at either when you're talking about variance, you're talking about either positive or negative, how volatile it moves, how much it moves all over this whole range. Ultimately, a lot of investing comes down to these bell-shaped curves, and how, when you look at option pricing is related to the bell-shaped curve and what that distribution is. When you're talking about, Robinhood tells you 79% chance of being out of the money or whatever at expiration. That's what they're basing that on is using a bell-shaped curve.
Right.
Yeah.
Right.
Yeah. So postmodern portfolio theory is kind of a refinement of modern portfolio theory, where they only look at negative, loss of money. This is kind of referring back to that rule number 1, never lose money, right? So the same kind of thing. They're only just looking at downside risk. It's another thing, another tool that you can potentially employ, but it's much more complicated to do the actual math, but still something that's out there that if you're interested in, you can kind of learn a little bit more about.
So they don't look at upside, they only look at downside risk?
Exactly. It only looks at downside risk.
That's kind of interesting. I guess that's the most emotional, scariest part, because the whole point is to conserve capital.
Exactly.
So
yeah.
Capital.
Capital.
Yeah,
that's one of the more recent ones. It's since 1993 or so. So it's a little bit more modern invention there. There's even whole models, system risk. We're talking about how like a bank or a hedge fund will manage their entire portfolio risk across the thing. It gets interesting as you're talking about large sums of money and multiple different asset classes and how to determine where you are in terms of risk reward ratio.
I would love to see Kathy Woods. I would love to see how she does her stuff.
It's probably just like a straight line.
Yeah, probably.
All right, guys. Well, thanks for tuning in. Hopefully you found at least a little bit of useful information about position sizing out of this video. If you did, give us a little comment down below. Let us know what you thought.
This is an important one. I'm still working on this myself. Please, this is probably the most important aspect of trading. A lot of times you have to learn this through losing a bunch of money. So if anyone can learn this without losing a bunch of money, that would be awesome, because that's how I learned, unfortunately.
Exactly. You ever heard the parable like the wise man versus the smart man?
No.
Yeah. The wise man learns from his own mistakes. The smart man learns from someone else's mistakes.
Oh, fair enough. Okay.
Try to be the smart man.
I'd be the wise one in this one. Okay. Be the smart one.
Yeah, exactly. All right. Well, thanks for tuning in, guys.
Have a good one.